Euroclear settles over $1 trillion in securities transactions every day. And now they're using distributed ledger technology to rebuild how government bonds move through the European financial system. Most conversations about tokenization get stuck on crypto hype, but the real shift is happening inside regulated depositories. The ECB just cleared digital bonds as eligible collateral from March 2026, and Euroclear's D-FMI has already settled notes from the World Bank, France, and Doha Bank. The €300 billion figure refers to Project Pythagore, their plan to move France's commercial paper market on ledger by late 2026. What you're about to see is how institutional tokenization works when policy and infrastructure lock in. Framing: signal versus noise in institutional tokenization. When people hear the word tokenization, most minds jump to retail crypto because that's the version that dominates headlines and social media conversations. They picture speculative tokens on public blockchains with no legal anchor and no regulatory clarity. That's not what Euroclear is doing, and the distinction is worth making. The €300 billion figure in the title comes from Project Pythagore. That's Euroclear's joint initiative with Banque de France to move France's negotiable European commercial paper market onto a distributed ledger by late 2026. The NEUCP market is where large European corporations and financial institutions issue short-term debt, and it holds roughly €310 billion in outstanding balance. That's a massive target, but it's commercial paper, not government bonds. The deeper signal for sovereign and supranational debt is D-FMI, Euroclear's digital financial market infrastructure. D-FMI is the blueprint for how government bonds can migrate to this technology without breaking the legal or regulatory plumbing that makes these markets safe. It's a new component of the existing Euroclear system, not a replacement. It operates under the same CSDR compliance that governs trillions in settled volume today. Notes on D-FMI aren't crypto assets circulating on permissionless networks. They're international securities governed by applicable law, recorded in a central securities depository, and serviced by traditional agents like Citi. The architecture matters here. For investors who care about infrastructure adoption curves, the question isn't whether a technology is novel. It's whether the institutions that already control the market have a reason to adopt it, and whether the regulators that oversee them have cleared the path. To see why D-FMI matters, you first need to understand how tightly regulated the current bond settlement chain actually is. The system looks efficient from the outside, but the friction lives in the handoffs between intermediaries, in the batch windows, and in the reconciliation loops that most investors never see. That's where the real settlement risk accumulates. Part 1. The Legacy Trap: How Government Bonds Settle Today. In Europe, government bonds don't trade like stocks on an exchange with instant settlement. They move through a chain of central securities depositories, international depositories like Euroclear and Clearstream, and the TAR-GET2 securities platform that the Eurosystem runs for Euro area settlement. CSDs maintain the definitive record of who owns what. ICSDs extend that model across borders, linking multiple domestic systems and payment rails. The architecture has held up for decades, but they built it for a world where information moved slowly and trust required an intermediary at every step. Think of a typical primary issuance for a government bond. The sovereign issuer works with syndicate banks who coordinate with an issuing and paying agent. That agent interfaces with the CSD, which records the book entry transfer and connects to the investor's custodian. Each step involves messages, confirmations, and reconciliations. Settlement cycles are short by historical standards, but they're still batch-oriented, with cutoff times and manual handoffs that create gaps. Those gaps are where settlement risk lives. You have two counterparties, two systems, and a delay between when each side fulfills its obligation. That delay might be hours or a day, but in a repo market or a derivatives margin call, hours matter. The existing infrastructure handles this safely because every participant is regulated and capitalized, but the architecture itself doesn't eliminate the gap, it only manages it. Repo markets compound this problem. When a dealer pledges a government bond as collateral for an intraday loan, the batch settlement cycle can delay the release or reallocation of that collateral. That creates funding inefficiencies that ripple through the fixed income market. Cross-border holdings amplify the complexity. Different time zones, legal frameworks, and market practices have to be harmonized across Euroclear's links to domestic CSDs and T2S. Intraday visibility into settlement status, collateral positions, and exposures across multiple custodians is limited. T2S has harmonized settlement in central bank money, but the process is still largely batch-based rather than continuous. Adding new instruments or structured products is slow because the systems predate programmable ledgers and rely on message-based interfacing. Government bonds do more than sit in portfolios. They function as foundational collateral in global repo markets, derivatives margining, and central bank liquidity operations. Any reduction in settlement friction or increase in collateral mobility can have wide implications for funding costs and liquidity management. But the current batch architecture limits how quickly collateral can be reallocated intraday. Here's what that friction actually looks like in practice. The World Bank's inaugural digital bond case study on Euroclear's D-FMI revealed exactly these friction points. Even a well-organized supranational issuance involved multiple message sequences between the issuer, syndicate banks, the issuing and paying agent, and custodians. Corporate actions like coupon payments required accurate position data across multiple layers of intermediaries. The process worked safely, but it wasn't smooth. The regulatory baseline is strict. CSDR mandates authorization, capital, governance, risk controls, and settlement discipline for any CSD operating in the European Union. These requirements are technology neutral in principle, but integrating the technology into a CSD's core systems raises real questions about how settlement finality is achieved on a ledger, how operational resilience is maintained, and how the legal framework stays intact. Any new platform must answer those questions before it can support large-scale government bond issuance. This doesn't mean the legacy system is broken. It means they built it for a world that no longer exists. That's the gap that distributed ledger-based settlement is actually trying to close. Part 2. The D-FMI Blueprint. Inside the infrastructure. Euroclear's digital financial market infrastructure is a new component of the existing Euroclear system. It uses R3 Corda as its distributed ledger layer, but it doesn't operate like a public blockchain. It's a permissioned infrastructure where Euroclear controls the nodes, and every participant is a known, regulated entity. That design choice is deliberate because it preserves the legal and regulatory status that the legacy platform has built over decades. Settlement finality on a distributed ledger isn't automatic. It depends on who controls the nodes, how consensus is reached, and whether the legal system recognizes the ledger as the definitive record. By using a permissioned model inside an existing CSD, Euroclear solved the legal question before it became a regulatory dispute. The securities issued on D-FMI are called digitally native notes. They aren't digital representations of conventional bonds. They're issued natively on the distributed ledger, and the ledger itself forms part of the official record of holdings under the Euroclear system's legal framework. Euroclear designed D-FMI to comply with CSDR from the start, without relying on any sandbox or pilot regime. That distinction is worth making, because most early tokenization experiments operated outside the CSD and central bank framework entirely. The inaugural transaction came in October 2023, when the World Bank issued its first digital bond on the platform. English law governed the bond, with Citi serving as the first issuing and paying agent on the platform, and R3's Corda powering the ledger infrastructure. That transaction proved the technology and legal design could work at a basic level. Since then, the pilots have expanded deliberately. Caisse de dépôt issued a digitally native note in the context of Eurosystem exploratory work, with Banque de France and Natixis involved as intermediaries. That signaled public sector interest beyond multilateral development banks. In November 2024, France issued its first digitally native note for 100 million euros, settled with a wholesale central bank digital currency token provided by Banque de France. That tested the cash leg in central bank money. In December 2025, Doha Bank issued $150 million in floating-rate digitally native notes, becoming the first Asia-based issuer on the platform and the first USD-denominated digital issuance for Euroclear. Standard Chartered, led that transaction. Each pilot tests a different dimension. The World Bank proved supranational issuance using the ledger. Caisse des Dépôts brought in French public sector participation and Eurosystem coordination. France tested wholesale CBDC settlement, and Doha Bank proved multi-currency capability and geographic expansion. The pattern is methodical, not random. By late 2025, D-FMI clearly wasn't a single experiment. It had become a methodical expansion of what the infrastructure could legally and technically handle. But there's a constraint. D-FMI initially supports only English law-governed debt securities, and the platform handles issuance and primary settlement on the distributed ledger, while secondary market settlement remains on the legacy system. That hybrid design preserves legal certainty and regulatory continuity. But it also means the full promise of atomic delivery versus payment and programmable settlement won't arrive until the cash leg and secondary market infrastructure catch up. Part 3. The 2026 inflection. Policy meets infrastructure. The policy signal that changes the incentive structure arrived on January 27, 2026. The European Central Bank announced that marketable assets issued in CSDs using DLT-based services would become eligible as collateral for Eurosystem credit operations from March 30, 2026. These assets are treated like any other marketable assets for collateral purposes. They face identical eligibility criteria and collateral management requirements, including settlement and CSDR compliance systems that are reachable via T2S or that meet equivalent standards. This decision explicitly avoids creating a separate, more lenient regime for DLT-based securities. Instead, it insists on technology neutrality. A bond recorded on a distributed ledger must meet the same high standards for safety, efficiency, and legal certainty as a bond recorded on a conventional database. For Euroclear's D-FMI, that means the platform isn't treated as an experimental sandbox. It's held to identical requirements as the rest of the Euroclear system. This technology-neutral stance also matters for other CSDs and ICSDs watching Euroclear's experiment. If the ECB had created a lighter regulatory regime for DLT-based securities, it would have signaled that digital bonds were a sideshow. By insisting on identical standards, the ECB is treating DLT as a genuine alternative architecture for the core market, not a sandbox experiment. For issuers, collateral eligibility is a cornerstone of liquidity and pricing. Government and supranational bonds that can't be used in Eurosystem credit operations trade at a structural disadvantage. The World Bank's inaugural digitally native note didn't primarily target Eurosystem collateral usage. It served as a proof of concept and a funding operation. But as the 2026 decision takes effect, future benchmark government bonds can be structured as digitally native notes with full collateral eligibility from inception. That changes the issuer calculus. The scale ambition became clear in October 2025 when Euroclear and Banque de France announced Project Pythagore. The target is France's negotiable European commercial paper market. Euroclear wants to put that entire plumbing system on Ledger, using its own ledger-based platform for issuance and settlement, with Banque de France providing wholesale CBDC for the cash leg. The pilot is targeted for late 2026, timed to coincide with the Eurosystem's Pontes solution. Pontes is designed to bridge ledger-based platforms with the European Central Bank's existing target services. It acts as middleware between the old financial world and the tokenized one. Jürgen Uaknein, who leads digital asset strategy at Euroclear, has stated clearly that wholesale CBDCs are the right settlement asset for wholesale markets at this scale, because central bank money eliminates the counterparty risk that comes with any private stablecoin. He's also stated that no single blockchain will dominate finance. The future is multiple interoperable distributed ledger environments connected by middleware like Pontes. Connection. The system view. So let's step back, because the individual pieces only make sense when you see how they interact. You have legacy settlement that works, but has friction. You have a ledger-based component that preserves legal certainty and regulatory compliance. And you have central bank policy that puts on ledger bonds on equal footing with conventional ones. When all three lock in, the result is a hybrid system that neither legacy infrastructure nor standalone DLT could build alone. Euroclear isn't replacing the plumbing, they're installing a new pipe inside the existing wall, with the same building codes, and the inspector just approved the connection. Faster primary issuance reduces settlement risk, while collateral eligibility preserves liquidity. Wholesale CBDC settlement through Pontes compresses the cash leg gap, and programmable settlement could eventually enable intraday repo and automated corporate actions. And this is where most observers get the timeline wrong. They treat D-FMI as a pilot, but that's a misunderstanding. It's a production component with production regulatory status, and the ECB just treated it as such. When those effects compound, the result goes beyond faster settlement. It changes how liquidity is managed across the European fixed income market. Collateral that moves in hours instead of days can be redeployed more efficiently, and funding costs compress as a result. The distinction between primary issuance and secondary trading starts to blur when both legs of a transaction settle atomically. The United States has its own tokenization momentum. BlackRock's BUIDL fund, Franklin Templeton's on-chain money market fund, and JP Morgan's Connexus platform are all notable initiatives. But those are primarily asset manager or bank-driven. Euroclear's approach is different because it's anchored by a central securities depository and integrated with central bank policy. That changes the nature of the adoption curve. The shift also isn't universal, because India's central bank has signaled it's not looking to enable direct settlement of government securities via offshore platforms like Euroclear. That reminds us that domestic policy sovereignty still matters, and not every sovereign debt market will migrate to offshore distributed ledger settlement. The Euroclear blueprint is powerful, but it's not inevitable everywhere. Once you see the system this way, the individual pilots stop looking like isolated experiments and start looking like early nodes in a network that's already being built. Takeaways: what to watch. If you're trying to separate signal from noise in digital finance, here are 3 things to watch. First, track issuer adoption, not transaction volume. A few benchmark government digitally native notes from core euro area sovereigns would signal faster migration than dozens of small pilot bonds from niche issuers. The quality of the issuer matters more than the count. Second, watch the cash leg architecture. Whether the Eurosystem settles via traditional RTGS or wholesale CBDC through Pontes determines how fast atomic delivery versus payment and intraday liquidity become real. The cash side is where the bottleneck lives. Third, monitor interoperability beyond Euroclear itself. Oaknin is right that no single chain will dominate. Pontes is the middleware bet that connects disparate distributed ledger environments with target services. If that bridge works, other Eurozone central banks can replicate the Banque de France template. If this kind of structural analysis is useful to you, subscribe. This channel is built for exactly this type of research. And if you want the United States parallel, I've covered the DTCC Project Ion mandate in a separate breakdown, which is the video to watch next. The real next milestone isn't another pilot. It's the first major sovereign bond issued as a digitally native note with full Eurosystem collateral eligibility from day one, because that shifts the conversation from experimentation to standard practice. When that happens, the blueprint becomes the standard.